So one of the themes in this reporting season clearly is the return of the shopper. As June Bailu said, some retailers, JB Hi-Fi, Harvey Norman, Adair, did better than expected. Also, Coles shares soared after its results showed it's gaining even more market share from its larger rival Woolworths. Now, on a normalised basis, Coles supermarket revenue was ahead 9%, and that shows Coles is taking market share from Woolworths. And that's something that Woolies Chief Executive Amanda Bardwell struggled to explain this week.
What we've been focused on is making sure that we provide lower prices for our customers. We're focused on building customer trust.
But that's not the answer to the question.
We're focused on building customer trust, which takes time.
I get that, but why are the customers moving with their feet to an opposing supermarket? You're telling us about what they want, but why is it that they're moving? Is it because they perceive Woolworths to be a higher priced supermarket?
Based on all the customer tracking that we're doing, we're seeing positive feedback from our customers that we've lowered shelf prices, and they're valuing that. But it's going to take time to completely rebuild customer trust.
Now, the curious part of all this is the stats show that Woolworths cut its average prices over the past year, while Coles increased its average prices by 1.2%, excluding tobacco. Yet Coles still managed to increase its sales faster than Woolworths, and that's the clear sign that customers are moving with their feet. Well, earlier this week, I spoke with Coles Chief Executive Leah Weckert.
The sales result that we've reported today really is a result of a number of initiatives that we have rolled out over the last couple of years. In particular, we have been investing in value and price for customers, and we've actually dropped the price on another 240 products today. But we've also had a very significant focus on availability. So when customers come in to shop with us, they can actually find all the things on their list. And our automated distribution centres in both Queensland and New South Wales are really helping with this. And then from an online perspective, we opened 2 automated fulfilment centres in Melbourne and Sydney in the last 12 months, and that is really helping to drive our online sales.
So just looking at food price inflation, 1.5% for the year, 1.2% excluding tobacco, that says to me that the COVID bout of inflation has passed through our economy.
Yeah, pleasingly for customers, inflation in our business has been very steady at around that 1.2% excluding tobacco for the whole of the 25 financial year. And we've actually seen now a number of categories that are starting to move into deflation, including in the non-food space like toilet paper and dishwashing. We've also got a couple of meat categories like pork and chicken that are also moving into deflation.
OK, so then you've got efficiency inside your supermarkets, you've got deflation in food prices, attracting more shoppers through the door. But the real trick here is even your e-commerce sales up by 24%. So those automated distribution centres, a deal you did with Ocado many years ago, is really now starting to pay some dividends.
Yeah, we're really pleased with the performance of the automated customer fulfilment centres. Their performance over the last 12 months has actually been ahead of our overall e-commerce rate, so the growth has been higher, and that's really driven by the proposition that customers are seeing. So there's more range to choose from. The products that you get last longer in your fridge, and you very rarely have a missing item from your order, and you put all that together and it's something that's very strong in the market.
So, Leah, I did a little calculation. You'd have seen, of course, the productivity roundtable the government had last week, and the Productivity Commission's idea that there should be a 5% tax on net cash flow. Now, I worked it out for you today. Your free cash flow, $2.93 billion, would mean you would have paid $147 million in extra tax. That's about 13% of the net profit of Coles in the last financial year. Is this a good idea for supermarkets or not?
So I think we would have a view that any conversation around improving productivity in Australia is a good and positive conversation to be having. But we don't believe that we're going to see improvements on productivity by taxing businesses more, whether that's small, medium or large businesses, because large businesses actually disproportionately drive a lot of the productivity gains that we see as a nation. And so we would like to see incentives in place to actually see more investment into areas like innovation, technology and skills growth. And we think that that is the key to seeing productivity going forward.
Because there's a reality here, just like GST when it was introduced. If you get whacked with an extra tax of $150 million, you inevitably have to pass that on to consumers, and they're the ones that ultimately have to pay the price.
It's a real impact to our business if it was to come in, and it would likely mean that we could invest less in the customer proposition and actually in productivity initiatives that we have invested in the last couple of years, like the automated distribution centres that we've opened in the last 24 months.
So just tell me, the view, the mood of your consumer right now, of your customers, is it improving to your sense? I mean, there was a real cost of living crisis going back 18 months or so ago. Is that started to lift to your sense?
So cost of living is definitely still on the majority of Australian households' minds. But I think what's very pleasing is in our latest surveys, we've seen the first green shoots that sentiment might be starting to turn, which means that with things like the interest rate cut, customers are feeling a bit more confident about their budget going forward, and perhaps feeling a little bit more confident at spending on goods. And I think the food spend that we saw come through from the ABS for June at 6.3% is indicative of that customer starting to feel more confident. Time will tell, though, on how long it actually takes to drive changes in the behaviours that we've seen over the last couple of years, like shopping at more retailers and trading down to more affordable products.
I'll tell you what, Leah Weckert, good to chat to you today, and many thanks for your time.
Thanks, Ross. Appreciate it.